In today's video, we continue with part 2 of my interview with the Michael Blanc. In this video, Michael and I will talk about why we believe multifamily is the best investment on the planet. I'm Michael Parks, helping you to invest in apartment buildings to live life on your own terms. Here we go.
Why multifamily? So, there's a lot of different real estate asset classes out there. What is attractive to multifamily for you?
Well, many different things. And it depends on which hat you're wearing, right? If you're a passive investor, let's start there because I mean that's who we're talking about. A passive investor. What's first of all, it's largely passive. I mean, I think the most passive you can get or should get, and I think the majority of the work is spent vetting the operator. So you're doing a lot more. Doing a lot more due diligence on the partnership than you are maybe on the average stock. That is true. I have found that most passive investors invest with one operator over and over again, and maybe for good measure they add a second. But it's not like they're investing with 10, right? So they're getting really close to one or two, to listen to the podcast, a YouTube video, or maybe read a book. They have a meeting with them. They look them in the eye. They shake the hand, go, "Hey, I've listened to their stuff, watched their stuff. They seem like a good guy. I'm going to go ahead and invest with that person." And so I like it because it's largely passive. I like it because of its performance in down cycles. I mean, you don't think back when I got started in the restaurants and you're personally guaranteeing leases, no one think I'm not thinking of the downside. What could possibly happen if I personally signed this lease? Screw that. That's not going to happen. Right. So now I'm much more sensitive to the downside. Yes, everybody wants upside, but I'm mostly concerned about the downside. Like what's the downside? If you study how multifamily real estate specifically, even things like mobile home parks and self-storage, how they performed in the last recession, it was amazing. I mean, the worst that happened is rent stayed flat for like 2 years, right? And then you look how it performed during COVID. Same thing, multifamily, self-storage, and mobile home parks, very strong through this last recession. So I love how it performs, and if the market's going great, there's incredible upside. I mean, incredible upside. So I like how it performs. I like the consistent returns. We talked about a 15% average annual return is our target, and with the stock market, the average annual return is like 7%. And the reason that's the average annual return is because it goes up 20%, goes down 10%, goes up 20%. It's like this volatility, and it decimates your principal average. So the actual average return of a stock market is actually a lot lower. And then we talked about these tax benefits. Every time your financial advisor or your broker sells a stock, you're paying taxes on the gain, and makes everybody very happy because government gets paid, the broker gets paid a nice commission, and you basically lose, right? So you have to pay capital gains on your stock, and as we talked about, real estate as well as oil, for example, has amazing tax benefits. So those are just a very small advantages of why I like multifamily.
Yeah, yeah. And you mentioned signing those leases back with the restaurants, right? And I was thinking when I signed my leases, you're right. I was signing. That was the biggest risk of all. That was
Oh,
signing up
horrible,
for millions of dollars
horrible.
in lease liability.
Oh yeah.
So when you contrast that with the financing that's available in multifamily with non-recourse loans in many cases, um, the bank is taking the risk on a lot of that.
Well,
Yeah.
they are, but that's another beauty. Thank you for mentioning it, is a limited liability, the limited partnership component of that. You're a limited partner, meaning that the most you can ever lose is your initial investment, which sounds pretty bad, and it is. The problem is, as you're an active partner, you're signing a lease, you can lose a lot more than your initial investment. You got to deal with lawsuits, right? I mean, the exposure is basically unlimited. I mean, a lawsuit she could sue you for a million or two, whatever. And so, as an investor, your downside is the worst case that you can lose your investment in your deal. But you don't have to deal with any kind of liability. And I didn't think about that because I got sued during my restaurant days. I mean, of course, all made up horse manure stuff, but still, I was never aware of the almost unlimited liability of taking it on something like a restaurant.
Yeah. No, you're right, and you don't think about those things sometimes until it's too late. So yeah, there's another great reason to invest as a limited partner, limited liability, and hopefully you get a lot of upside. So I love the fact that multifamily does perform well in tougher economies, right? And I've been trying to figure out why that is, and I have a theory, and maybe you tell me what your thoughts are. But one of the things that happens is when the economy is not doing well, then there's less people able to afford houses and make those initial investments. And so it actually drives more rentals of apartments. It actually has an effect of bolstering the demand for apartments. Whereas when the economy is doing really well, more people are thinking about moving into maybe a house of their own. And so I don't know what your thoughts are on that. Why do you think that it does well in down markets too?
So I think it depends a little bit on the specific niche of the real estate. I mean, let's think about this. And I'm not. People always think that it's all one thing. They say, "Oh, I lost money in real estate some time ago. All real estate is bad." No, there's difference even in commercial real estate. I mean, look at the office space right now. It got
Mm,
crushed by COVID,
brutal.
just crushed. And it didn't do very well in the last recession either because people got laid off, lost their jobs, and offices were empty, right? So, on the other hand, if you look at the assets that perform very well, even in multifamily space, Class A, the fancy stuff got crushed in last. I mean, you should have seen the vacancies in Miami. You had all these cranes going into the recession. I remember I was down there and I was like, oh my gosh, this is incredible. And then as soon as the recession hit, work stopped immediately. Everything was basically it was a ghost town. So Class A got killed. Meanwhile, Class B and Class C, which is the more affordable housing, did very well. And here's why: there is a shortage of affordable housing, and that is because you can't build any more affordable housing, especially now. The cost house, the construction cost alone far exceeds the rental income you can get in the affordable housing space. Therefore, you can only build new Class A stuff that is $1,000 a month in rent to actually pay for all the stuff. Therefore, they can't make any more affordable housing. There's always a shortage. And so what happens, you have this trickle down effect. People who live in houses lost their houses in 2008, moved into an apartment. Wow, that bolsters the rental market, right? People who were living in Class A, oh gosh, I can't afford it. They went to Class B. People who were in Class B moved to Class C, right? People who are in Class C, there's really nowhere to go unless they move to the ghetto, which, if you're a responsible parent, you're going to do everything you can not to move into a ghetto to keep their children safe, right? So Class C is like this collection point for everybody. Class B and C is very affordable housing. They can't make anymore, and people need a place to live. And with COVID, for example, we were concerned that people would just default on the rent, not necessarily because they lost their job, but because of all these eviction moratoriums. They're like, "Ha, I'm just going to stop paying. Get me if you can." Now that didn't happen, which I found interesting. I have a theory about that. It's because there was so much uncertainty with their own health, their loved ones' health, their jobs. The one thing they did not want to risk was the certainty of a roof overhead. Why risk the eviction moratorium being expired? Now you're $3,000 in the hole. You don't have $3,000. You're going to get evicted. And people were like, I don't think I want that. I think I'm going to keep paying the rent. I'm going to stop going to the gym, going out to eat, but I'm going to keep paying my rent. That's exactly what happened.
Yeah, interesting. I mean, I do have some Class C apartments as well, and I did see some of the collections fall off, but it was interesting. It wasn't across the board. It was a few individuals who just took the initiative to say, "You can't evict me,"
Yeah,
and
there's question, no
uh,
question. And then some
and
people actually did lose their jobs. There's no question that people,
yeah,
and it is location specific.
yeah,
It's people who, for some reason, you have demographic makeup where people are working in retail or restaurants or hospitality, for example. Those were more affected than others who were, say, tradesmen, for example. Right? These are workers, still Class C, but the makeup, which before wasn't relevant whatsoever. Like you wouldn't go in there and your due diligence go, what's my makeup? What are people's jobs? Like now, it's like we actually look at what are people's jobs right now? Like, is everybody in one particular industry? Is it all over the place? And now we're paying attention to some of the stuff way more than before. So it is a building by building, neighborhood by neighborhood. We're affected unequally. That's exactly right.
yeah. And what I've found interesting just in the last couple months, I think there's a lot of positivity right now around getting past this pandemic, and both some government assistance funds have come through, as well as people have now just started becoming current because they realize that the moratorium on evictions is ending. And to your point, they don't want to be without a place to live. So I've actually found that collections have gotten significantly better just in the last month and a half
Yes.
for my properties anyway.
Yes.
Good. So the market for multifamily is hot, right? So we cap rates, which basically is related to prices, right? Prices tend to be high right now, um, as cap rates are low. And so interest rates have been low. And so where does it go from here? What do you think? I mean, are we going to continue to see cap rates going down? I mean, they're pretty low to begin with. What are your thoughts?
It's hard to say. Cap rates are pegged to interest rates on the one hand, but also to the level of demand for the asset. So there was a time, I can't remember, was it December of 2019, where interest rates went up for like a crazy, like 2-month period. It was like, oh my gosh, what's happening right now? And lenders were all wigged out, and we couldn't get rate locks, and it created a problem for a bunch of people. And during that time, we did not see prices come down at all. Prices stayed exactly the same. We're like, whoa, what is going on right now? And it showed that there was so much demand for the asset class, so much money that wanted to get in, that they were like, you know what? Did I want a 10% return? You know what? I'll sell it for 9. And they continued paying for the same thing as before. So that was interesting. I think there's continued demand for multifamily. There's no question in my mind. There's nothing that's going to drive down the demand for multifamily. It's just going to stay at least the same, if not more. Interest rates, which do affect the returns, if you look at the Fed and their guidance is they're not going to touch interest rates for a year, for a year. So it's going to stay exactly the same. It's crazy, right? So the cap rates aren't going to get. It's not going to. I would think the cap rate's going to be equal to or lower moving forward. And the only reason they would possibly move lower is if people are willing to pay more, because they're willing to settle for lower returns, because they're not getting a return elsewhere, or they're not getting the risk profile they want. So now, when we project our exit, we're still projecting higher cap rates just for good measure.
Yep.
You know,
Conservative approach.
but but what's going to happen to cap rates? I don't know. I don't see them going up right now. Not for the next 12 months.
Yeah, and one of the nice things about multifamily loans is you can typically lock in those interest rates for some extended periods of time so that you can weather some storms if they should start to creep up on you.
Hmm.
Good. Michael, a lot of people look at housing like single family houses and the prices that single family houses are going for and saying, "Oh my gosh, is this another bubble?" Right? And I think what's interesting is that single family houses and the way those get valued are very different than multifamily, right? 5 or more units. And so I often find that people don't understand. They think just because the house that they might want to live in is really expensive, that and it could drop really fast, as happened in the housing bubble. That same thing happens in multifamily. And my guess is that that's not exactly the way it works with multifamily. You want to
No,
explain that a little bit?
yeah. They're really unrelated to a large degree. Housing values are really driven by the affordability of the mortgage, right? Which in some degrees is similar to the rent. One of the reasons we had a run up in 2008 was interest rates started plummeting, and everybody who could fog a mirror could get a loan. So therefore, the mortgage payment they had was the same as it was a year or two, but the interest rates were lower. The terms were much more generous. Therefore, they could afford more house. And so that's what drove up, and so to some extent, a lower interest rate has also, in the same way, driven up housing prices higher. Now, if interest rates were to go up suddenly, that would immediately affect housing prices, right? Because people's mortgage payments are going to go up. So, I think the relation to interest rates, which affects affordability, has a direct correlation to real estate, right? So, if interest rates do go up, I think that will definitely affect housing values.
Yeah, and the other thing with multifamily, as you know, is it's based on the amount of income that the property produces, right? It's basically buying a business. So what you're going to pay for that business is dependent on the profits that business makes.
Yeah.
And when you go look at a house, you're looking at, well, what have other houses like it sold for, which is not exactly the way multifamily gets valued
Yeah.
as
Yeah.
well.
That's exactly right. And this is why I love the space, is because we have a high degree of control over the value of the building. I can what's called force value, force appreciation. And that's very powerful because I can go in there with a business plan to raise rents, do some renovations, raise rents, therefore raising the value of the building. Now I can refinance the higher valuation, repay the investors their money, and continue holding on the building, and then do it again maybe 10 years from now. Who knows? So that's a really strong strategy that really doesn't work. I mean, gosh, what other businesses that work in? Definitely doesn't work with hair salons or
Right.
restaurants. I mean, as soon as you open the door, whatever you just paid to open it goes down. It's like driving a car off the lot. And and with multifamily, it's not like that at all. So I do like the fact that your destiny is much more in your control.
Yes. Yeah, I like that as well. And in fact, a lot of times people will see an underperforming asset, right? A building where rents are low and maybe doesn't appear to make so much money. People look at that and say, well, why would I want to buy that building? And to me, those are the low risk opportunities because you can go in and drive that value up quickly and give yourself a cushion there. And so you basically build equity extremely fast, even if you don't actually change the building all that much. Well, you've changed the economics of how it's performing.
Yeah.
Good. I assume, Michael, that you still think multifamily is a good investment today, right?
Yeah, absolutely. I mean, otherwise I wouldn't do it. I am certainly committed to the strategy itself. Um, but you know, again, because of how long it's been around, how long it's performed through various down cycles, a lot would have to happen for that not to be an investment anymore. I mean, even people are concerned about inflation, for example. Oh my gosh, inflation, right? It's a real risk. I love inflation. Inflation makes my debt worth less and it makes my income go up. Now, it makes my expenses go up as well, but if you plot it out on a spreadsheet, which of course, Michael, I have done, the gap widens as inflation goes up. The gap between income and expenses actually goes up, therefore increasing your NOI, therefore increasing the value of the building. So let inflation come, because the higher inflation gets, the more cash flow I get, and the higher the value of the building.
Right. Yeah. It's a great inflation hedge, which is exactly your point.
We're going to break right here. I hope you enjoyed hearing Michael's perspective on what makes multifamily the best investment on the planet. Stay tuned for the conclusion of our interview next time, when Michael and I talk about real estate syndications and why we believe it's the easiest way to add high-quality real estate to your portfolio. Here's how you learn more about Michael.
So we have resources for both passive and active investors, and you can find everything at themichaelblanc.com. We have a book called Financial Freedom with Real Estate for people who are active or passive who want to quit their job. We have a podcast called the Apartment Building Investing Podcast, and it's all about financial freedom with real estate. And those are some great ways that people can connect and find out more about us and what we do.
Terrific. Thanks, Michael.